Hi, my name is Keith Richards, Portfolio Manager, Valuetron Wealth Management, World Source Securities. And today we're going to be doing our very first Valuetron video, which will be part of both my regular blog at www.valuetron.ca, and it will also be available on YouTube. Today we're going to be talking about the S&P 500, the popular US stock market index, and we will be looking at the daily chart and taking a look at a formation that is known as a right angle triangle. The right angle triangle is a consolidation formation, and what that basically tells us is that the market is in a bit of a state of limbo at this point. It can't make up its mind which way it wants to go. So we're going to see how we can maybe interpret how we can trade by looking at this formation. So I want to draw your attention to the chart, and you'll see where I have drawn a flat line at the top indicating that the recent peaks on the S&P 500 have been more or less flat, somewhere contained at or below 2120, let's call it. Okay, I like using round numbers, by the way. We don't want to get too crazy with picking exact numbers. We're looking for general areas of consolidation. You can see the tops, the peaks on the S&P 500 have landed somewhere around 2120. You can see the troughs, the low points on the S&P 500 on the daily chart over the past couple months have been rising, and this is what forms this ascending triangle formation. So at some point, the S&P 500 will break one of these two levels. It'll take out the old top, or it'll break down below the prior trough. And those levels are 2120 on the top and somewhere around 2080 on the S&P on the bottom of this ascending triangle. What you want to look for is a break through one of those two levels. And I like using a rule of three, which basically says that if you do witness a break and you wish to trade in the direction of that break, give yourself at least 3 days before you trade. And the reason you do that is to avoid being whipsawed or being falsely led. I sometimes call these things head fakes, when the market gives you a head fake and then goes right back into the consolidation pattern. So give it at least 3 days, and even better, if you witness some volume, which are indicated by the bars at the bottom of the chart, and you see the volume spike on that breakout, that offers you a little bit more thoughts as far as whether this breakout is a legitimate one or not. So I'm going to cover a few things on the chart. The first thing I want to do is cover something called money flow, which is right at the bottom. So I've toggled down here, and you can see that this is what's called the accumulation distribution line, and it basically tells us the net amount of volume on positive days versus the net amount of volume on negative days, and it plots the line cumulatively. If money is flowing in on positive days with big volume, the line tends to go up. And if money is flowing out on negative days, then the line tends to go down. So we're looking for a net pattern, and you can see the pattern is bullish. So on the daily chart, we see that the money flow, the market is still, market participants are still liking this market very much. And that's a positive thing, because you need buyers to continue pushing markets up. So that's the bottom pane. But what I also want to bring your attention to are some momentum indicators. And people sometimes get a little carried away with momentum indicators, because the thing I want you to understand is the momentum indicators are simply icing on the cake. They give you some clues. They are not the thing you trade off of, unless you're a very short-term market timer. Okay? But what we can see here is Stochastics, which is a very, very short, quick reacting momentum indicator. We've got RSI in the middle, and then MACD at the bottom. What I'm trying to show you here is that Stochastics and RSI, which are kind of short and medium term momentum indicators, are both more or less benign. They're trading kind of sideways. And what that tells us is not a lot. It tells us that, just like the consolidation period on the chart above, we are in never never land as far as which way the market is going to trade. The momentum indicators, Stochastics and RSI, are not giving us many clues. Let's go to the longer term momentum indicator, which is called MACD, moving average convergence divergence, and it's a little bit different. It doesn't work on velocity as much as the two I just mentioned. It's actually measuring the difference between two moving averages and plotting that net difference, and it uses a signal line. I won't go into all the mechanics of MACD because the main thing I want to look for here is something called divergence. And divergence means if the indicator is moving in the opposite direction to the market, it can give us clues that things are slowing down, despite the fact that on the chart it looks like things are progressing nicely. So MACD is diverging. As you can see, the high back in February was higher than the recent high on MACD. Okay. The last time it did this was back at the end of 2014, and I'll toggle up the chart a little bit. You can see that MACD diverged. There's a high in basically mid-November, and it started falling and made a lower low in December. Meanwhile, the stock market mid-November was moving higher, and then in December it made a higher high. So you had divergence, and that led us into a very choppy period, you might remember, in the new year, January. Okay, so we're getting a somewhat similar looking pattern right now as the market moves through its consolidation, although the market is not making new highs. So my thoughts on this are that MACD is just one indicator. It is not the holy grail of indicators. It is simply giving us one potential clue as to which way the market will break out of this triangle. It may, according to MACD, want to break down. However, none of the other indicators, including, most importantly, money flow, are showing us anything bearish on the market right now. So my advice would be that one would not want to trade aggressively in one direction or another as the market works its way through this consolidation period. My thoughts are wait for the breakout, whether it's to the downside or the upside, wait your 3 days, and then trade in that direction. This is Keith Richards, Value Trend Wealth Management, and thank you for joining me.